welcome to Wealth Manager, where we help make your money work for you. On the show today, we'll talk about investment strategies with Aashish Somaiyaa, MD, Motilal Oswal AMC. The real estate bill will benefit home buyers. Mudassar Zaidi, National Director Residential at Knight Frank, will join in. And we'll decode DSP BlackRock's new equity savings fund. The mutual fund industry has been going through some rough weather. AUMs have fallen and equity flows have slowed down as a result of the ongoing market volatility. But the question is whether this is the time to reduce allocation to equity or top up your equity holdings. To discuss this and more, I'm joined by Aashish Somaiyaa, MD and CEO, Motilal Oswal AMC. Thanks very much, Aashish, for joining me on the show. So as I was saying, equity flows have slowed down for the past few months. In fact, in Feb, we saw the lowest equity inflows in almost 2 years. Do you think that's a trend that could continue in the next few months, or could we see some respite in inflows going forward?
I think that, typically speaking, if you really ask me, compared to what we witnessed any time in the last, say, 5, 10, 15 years, the flows as far as equities are concerned in this financial year, I would classify them as resilient. Okay. Because in the past what we've seen is that as long as the market keeps going up, people have all the confidence to keep on, and they can see that the recent past returns have been good. So people have the confidence to keep allocating. And typically what we've seen is that the moment the market starts, 2-3 months of decline, you see people just pulling back. Right. So this time, in fact, I'm pretty impressed by the behavior of retail equity investors because consistently all through the fall, they have been investing all along. Yes. The other is, as you know, SIP flows are consistently increasing. We are more than 2,700 crores a month right now. So yes, all in all, I agree with the fact that January and February has witnessed a kind of slowdown. I wouldn't call it seasonal, or I wouldn't call it waiting for the budget. I definitely can see that continuously negative returns is impacting sentiment to some extent, but it's more temporary in nature. And on the whole, I would say that the maturity levels have increased dramatically. Right.
So what's the sense really that you're getting on ground from investors? What are the concerns and any redemption pressure at all?
So I wouldn't classify it as redemption pressure, but it always happens, this is on the margins. It always happens that, let's say you've seen a year back, you've seen 9,000 on the Nifty, and suddenly you see 6,800. It kind of creates the fear of God in your investing process. And then after seeing 6,800, you suddenly see 7,500. So there will be some people on the margin who will always think that, we've just seen the worst, maybe it will go back there. So let's take some money off the table. So it's that kind of behavior on the margins. But all in all, I would say flows, I'm expecting flows even this month to be net positive. Okay. We'll wait for the final numbers to come, but I'm pretty sure that they will be net positive. Okay. So do
you think we could ever see a situation in the next few months where the flows go into negative territory?
You know what, in the last 3 years, not 3 years, maybe 4 to 5 years, it's always happened that when FIs have been buying, domestic investors have been withdrawing. Right. And when FIs have been withdrawing, domestic investors have consistently been buying. I don't think you should prepare for a time where the flow turns the other way. I think we all need to really visualize and prepare for the time when both will be buying. So I'm waiting for that day, and I don't think it's far.
So volatility seems to have become the new normal. How does one create wealth in this kind of a market?
So I read it somewhere, a very interesting quote, and it said that all past corrections look like missed opportunities. Only this one feels like a threat. So
that's very true.
So the point is that if your goals are, say, for everybody the goals are some way off, and why do you want the market to be at its peak if your goals are, say, 5, 10, 15 years down the line? So the only way to make wealth is to make volatility your friend. Constantly review your asset allocation because there is a goal and there is a timeline to reach it. There is a return expectation. So you should review your asset allocation, and most importantly, you must take advantage of volatility, which is to invest more money. A lot of times people do SIP, but SIP is also in that sense slightly dumb because you allocate the same money all through. Right. Ideally, in periods like this, while your SIP is going on, you must try to allocate a little bit more. Okay. Because there's another huge irony that when the market is 9,000, people think it's too expensive, and when it's 6,800, people think it will go down even more. Correct. So when do you really invest? Yeah. So I think these are times one should take benefit.
Right. So which pockets are you really seeing value in right now? I'm not saying sectors because I don't think this is a market where one can really take sectoral bets, but where do you see value right now?
this is not a market which you can play broad brush by way of sectors, etc.
Right.
But broadly, if you have to play themes, I would still say that, a lot of high quality companies, which may have 20-30% earning growth, more than 20% ROEs, what you would classify as high quality or secular companies, a lot of them are beaten down by 30-40% in the last 8 to 9 months. So I would say stick to high quality. This is not a market, where you can just make a broad brush. See, 2014 people made broad brush assumptions. New government, great bullishness, everything is just going to fly through the roof. All that didn't play out. So we're not in a scenario where you can have a secular run. You need to be, so there are some trends. Like, for example, from here on, I can say banking will do pretty well.
Okay.
I think there's some serious reform happening. Last 2-3 years, everybody has been saying that we need reform and we need corruption to be cleaned up. Unfortunately, the first sign of reform and the market is people have started panicking. So a lot of value in banking, a lot of value in some areas like, auto, commercial vehicles, cement in some pockets, not across the country. And NBFCs, a lot of areas which have to do with consumption. If not now, maybe a year, couple of years later, with some lag effect you might see.
Right.
So yeah, these are broadly.
Okay. So you mentioned banking. Do you think the worst is over as far as the NPA issue is concerned? How would you play that sector going forward?
See, in the last 1 year, PSU bank index was down by more than 50%. And there has been this huge overhang of NPAs for at least 3 years now, maybe even longer. And for all this time, people just don't know what is going to get wiped out. Is it the whole capital, half the capital, 10%? What is it? So market always gives huge premium to certainty, and market always penalizes uncertainty very, very heavily. Right? That's why we have a market. To answer in short, I think the worst is behind us. Because number one, and whatever structural changes are happening, if you ask me, they are serious long-term reform which is happening. This is serious reform. This is what we've been waiting for all along. While it's happening, it's ugly, but it augurs really well. See, I think that whenever somebody speaks about aviation, people get really, really stuck up on oil price. Okay. Yes, it's a determinant. It really impacts. But we must not forget that there is some delta with relation to oil price and passenger volumes. If you leave out all of that, if you generally look at it, we are in a country where there is serious value migration happening from railways onto flights. Right? And over a period of 20 years that we've been flying around, all in all, I haven't seen flight fares actually going up. I have only seen fares coming down over a period of 15-20 years. Even without oil price being at 30, you generally see passenger volumes increasing by 8%, 10%, 12%. So what you really need to look for is that there is a broad trend where more people are flying, business activity is likely to increase. There is enough ability for people to move from railways to aircrafts. To take another example, in the US, for example, the biggest of airlines have thousands of aircrafts, more like 1,500, 2,000. In China, similar numbers. In India, the whole country has 250 aircrafts. So that's the level of penetration we are speaking about. So you're basically talking about a market where the growth is anywhere in the range of 10 to 20% depending on oil prices. There is serious underpenetration. And there is a long journey to go.
As you were talking about, mutual funds across the board have seen negative returns for the last year or so. What would your advice really be to investors at this point, possibly those who are thinking of redeeming right now? How should one allocate between mutual funds? What's your advice?
Investing, as far as possible, should be devoid of emotions, right? And if you've seen that movie, which is Munna by MBBS, he says that I may be the best doctor in the world, but if I operate my own daughter, my hands will start shaking. So that's where, professional management really comes in. And as professionals, we try to be as unemotional as possible. So as any investor in any form should try to be as unemotional as possible, right? Always keep in mind that ultimately, because there are some pockets of time when we get negative return, is ultimately why we eventually get a positive return. If the market were to go straight line up, I don't think anybody would ever have the guts to enter the market. So yeah, like I said, it's easy for me to speak, difficult for people to implement, but the reality is you have to take advantage of what is happening.
And finally, Aashish, for Motilal Oswal AMC, any change in investment strategy to sort of adapt to the volatile markets?
No, our entire investment strategy is about buying good quality companies and holding on through the entire growth cycle. So if you really ask me, the great thing about us is that we are a boring company. We won't change our investment philosophy or strategy because this is what we've evolved over the last 25, 30 years. And our belief is that investment strategies, it's not that an investor is going to give all his money to us. we would expect an investor to allocate some component and pick us for our investment style and our discipline, right? So I think the only thing which will not change is the kind of companies we pick. We'll always stick to what we call QGLP, which is high quality, growth oriented, longevity of competitive advantage, and if a company has QGNL, then try to acquire it at a fair price.
Right.
So I think that is something which we'll always stick to.
All right. On that note, thanks very much, Aashish, for joining us.
Thank you for having me here. Thanks.
All right, time for a short break. We'll come back and talk about the real estate bill and what it means for home buyers. Stay tuned.